Welcome to the third module of our IFRS number 5 e-learning course. In this module, we are going to explore the recognition and measurement aspects, including the initial recognition of the non-current assets held for sale, the measurement of these assets at fair value less cost to sell, and the recognition measurement of the discontinued operations. Let's start with the initial recognition of the non-current assets held for sale. When an asset meets the criteria for being classified as held for sale that we discussed in the previous module, so at this point of the date of the classification, it should be recognized at the lower of its carrying amount, which is updated carrying amount as of the date of the classification, and the fair value less cost to sell. So the company must assess the carrying amount and update it based on the date of the classification, and also assess the fair value less cost to sell on the date of the classification, and then select the lower out of these two components. Now, let's take an example. Suppose a company has an item of machinery with a carrying amount of $150,000. So this carrying amount is updated until the date of the classification, meaning that the accumulated depreciation is updated up to the date of the classification. After careful evaluation, the management decides to sell this machinery, maybe because the product that this machinery is producing is not anymore acceptable in the market, and we don't have demand on this product. That's why we need to sell this machine, because maybe this machine becoming old in age, maybe this machine becoming damaged, for example, maybe because we closed this line of business. So in this case, the management is going to sell this machinery. The fair value less cost to sell is estimated to $140,000. So as you see, the initial recognition would be at the lower of the carrying amount in one hand and the fair value less cost to sell in the other hand. Therefore, the machinery is initially recognized at $140,000, and this loss is being recognized in the statement of the profit or loss statement. Therefore, the machinery is initially recognized at $140,000, and the loss is recognized in the profit or loss statement, regardless of the accounting model that the company uses for this asset. To elaborate more on this topic and how to recognize the loss, let's take two different scenarios. If the company accounts for this asset under the cost model that we explained before in IAS number 16 or IAS number 38, because this asset can be BBE, can be intangible asset. So if the company accounts for this asset under cost model, the loss is recognized immediately in the statement of the profit or loss, which is the income statement. It is also reported as a separate line item, typically under other expenses of similar category or income from discontinued operation, which is aligned with IFRS number 5. So this loss will be reported in a separate line item under the name income or loss from discontinued operations or from assets held for sale. Now, in the other scenario, if the company accounts for these assets under the revaluation model, again, as per IAS number 16 or IAS number 38, where assets are carried at the fair value less any accumulated depreciation and the impairment losses. So the loss is still recognized immediately in the statement of the profit or loss, which is income statement. The loss is not netted against any revaluation surplus. Now, let's dive into the measurement aspect. IFRS number 5 requires assets held for sale to be measured at the fair value less cost to sell, as we explained before. Fair value represents here the amount obtainable from the sale of an asset in an arm's length transaction between knowledgeable and willing parties. These knowledgeable and willing parties are called market participants that have the full information about the asset, and they have the ability to pay the value and the price related to this asset, which means that they are serious in buying and selling these assets. So this definition of the fair value is aligned exactly with the definition of the fair value stated in IFRS number 13, which is related to the fair value measurement. Now, the question here is, what will happen if there is a potential gain regarding the increase in the fair value less cost to sell? So an entity in this case shall recognize a gain for any subsequent increase in the fair value less cost to sell of an asset, but not in excess of the cumulative impairment loss that has been recognized either in accordance with IFRS or previously in accordance with the IAS number 36, which is impairment of the asset, regardless of the asset accounted under cost model or revaluation model. Which means, in very short word, that we can recognize the gain up to the impairment loss that we have recognized before. So as an example, continue with our machinery example that we explored before. Let's assume that the fair value less cost to sell has been reevaluated, and now it is determined to be $145,000. So the machinery is remeasured at the new fair value less cost to sell, resulting in a revised carrying amount equal to $145,000. So let me emphasize on this statement again, that an entity shall recognize a gain for any subsequent increase in the fair value less cost to sell of a non-current asset that's being held for sale, but only to the extent of the cumulative impairment loss, which previously recognized either under IFRS number 5 or IAS number 36, which is related to the impairment of the assets, regardless of whether the asset has been previously measured under cost model or revaluation model. Moving on to the recognition and measurement of the discontinued operations. When an operation is discontinued, so it should be measured as if it were a separate entity engaging in a single transaction, determining the gain or loss on the disposal. So let's take an example in order to explain what should we do in terms of measurement and recognition of the discontinued operations. Imagine a company decides to discontinue one of its divisions. The carrying amount of the division net assets is $1.2 million, and the fair value less cost to sell is $1.3 million. The gain or loss on the disposal is calculated as the fair value less cost to sell minus the carrying amount. So in this case, it would be 1.3 million minus 1.2 million equal $100,000. And if the fair value is less than the carrying amount, it would result in a loss in this case. Let's summarize. The initial recognition of the non-current assets being held for sale is at the layer of carrying amount and the fair value less cost to sell. Subsequently, these assets are measured at the fair value less cost to sell. And for the discontinued operations, the gain or loss on the disposal is calculated as the fair value less cost to sell minus the carrying amount. And it must be reported as a separate line in the statement of the profit or loss. By following this approach in the presentation, you are again splitting between income from continuing operations, which are the operations that you are expected to continue in the next period, and income from discontinued operations, which are related to the discontinued operations and the assets that are being held for sale. In the next module, we are going to explore in details the measurement of the discontinued operations. Join me in the next module.